Everybody, without any further ado, we'll kick off. My name is Gianni Musumeci. I am the practice manager here at Riker Capital. We are a financial planning practice, and we're lucky enough to have Ricky Regmi with us today. Today, we're going to be going through a case study scenario where we have a couple in their 60s, and we're going to talk about how these clients, after implementing financial advice, went from 0 to full Centrelink age pension entitlements. Now, this was a client of Ricky Regmi, so I'd like to take this opportunity, firstly, to go through our advice disclaimer. Anything that we go through in this session is purely general in nature. It does not constitute personal financial advice. If you're looking to undertake financial advice that does consider your personal circumstances, needs, or objectives, please don't hesitate to reach out. We'll provide our details at the conclusion of this webinar. And throughout this webinar, if you do have any questions, please don't hesitate to leave them in the Q&A function of this webinar. There is a Teams meeting functionality that allows for questions and answers. If you do have any questions throughout, we'll look to stop at logical points to answer those questions, and then we'll pause at the conclusion of the webinar as well to go through any questions if we don't have time throughout. I want to take this opportunity to introduce Ricky. Ricky is one of our executive financial advisors here at Riker Capital. He's been in the financial planning industry since 2007, and after completing an accounting degree at Macquarie University, he's spent time in his career as a private client advisor with Commonwealth Bank. He's also an Army reservist and has been for over 15 years. One of the features of his career is he has been deployed to the Middle East in the area of operations in 2019 as a finance specialist. Nowadays, he plies his trade as an executive financial advisor with Riker Capital and understands the importance of financial advice in achieving people's goals, needs, and wants. In this session, we're going to go through a client scenario of Ricky's. And in this case, what we've done is we've used the client details and just stripped away any identifiable information. Without any further ado, I'd love to hand it over to Ricky to kick us off. Ricky, I'll give you control and I'll let you go from there.
Thanks, Gianni. Hope everyone can hear me. If you can't, please let us know. Our technical expert, Gianni, can look at it in the background. Well, guys, thank you for taking time out to coming and attending this webinar. So we'll just go through in this session about a client that I personally helped. We're talking about a couple who are coming up, finishing off work and starting retirement. So just to give you a bit of background, the client's age 67, 63, so there's about four years gap between the client's age. That's an important part. Like Gianni said, we've removed client's reference. So for the purposes of this webinar, we've named them Donald and Kamala. These are a very lovely couple. They're not fighting, they love each other. They've been married for a while. So looking at their situation, Donald's retiring due to redundancy. So he's got a big redundancy payout from work. And Kamala also, because he's retiring, she's also wanting to retire together. And so he can spend time, well, they can spend time together. They can do the things that they want to do, right? Traveling being one of the big ones that, as many couples do when they initially retire. Donald received a big sort of payout because of the redundancy. There was $100,000 that he got paid out. And Kamala, on the other hand, this was really important because she had a defined benefit super. So we don't see that much nowadays because we are all generally on accumulation scheme now. But defined benefit is an older style super where you worked with the employer for a while and then at the end you get a payout. So with Kamala, she didn't have the option to get a lifetime pension. Generally, defined benefits do offer that, but with her account, it only offered her lump sum money at the time of retirement. So that's a bit of a background that the client situation is. Obviously, when it comes to age pension, there's a different criteria that the client needs to meet, and we will go through that a bit more in detail as we move through the slides. Okay, so if you look at the next slide, so mainly why a client came to see us was retirement planning. Since they're retiring, they wanted to see what they can do, how they can make their lifestyle, continue on with their lifestyle to ensure that now that there's no money coming in, they can continue to live how they were living before. Another issue was tax payable because Donald got a big payout from work, the redundancy payout. There was a big, huge tax bill that came along with it. Another thing, to going back to the previous point, concern about longevity of the funds, which most retirees do. As you retire, there you need to understand how long would this money last, and lack of government assistance. So they did know that because of the money that they'll have that payout to them, they were aware that they might not be able to get any government support, especially for Donald, because he is of age pension age. So the recommended strategy at a high level, what we recommended clients to do, and guys, I probably wouldn't want to go too much into detail about the strategy because I'm scared that I might lose you. But happy to have a detailed conversation one-on-one if you wanted to discuss it further. So at a higher level, because Donald had a higher tax bill that came with it, so what we did was we did a what we call a catch-up contribution, where the salary sacrifice amount that the Donald hasn't been able to use, the concessional catch-up for the last 5 years, we were able to use it. So we decided to put in $60,000 contribution into Donald's super, which he was able to make a claim on at the tax time. So the whole 60,000, he was able to claim that on tax, right? We also did what we call a non-concessional contribution of 110,000 and 330,000. So it's over 2 financial years. There is a cap limit on how much money can be put into super. So we did $110,000 in the first financial year, and then 330,000 in the next financial year. It worked out really well because I saw them around May. So we were able to do first lot of contribution in June, and the second contribution went in July. Because Kamala got paid nearly 900,000, 950,000 from a super benefit because of part of a defined benefit. So that was at a high level. Again, we also did a review on how they were invested in the super, because it's with our super funds, we all have them, right? But we can't tell our super funds what to do, how to invest the money, but we can tell them how much risk we want to take with our money to ensure it, going back to that longevity of the fund, right? So it's making sure the money lasts as much as it can. So we did that super review. We started what we call an account-based pension to ensure that Donald continues to receive regular income from his super, to ensure that they have money coming in and they can meet their lifestyle needs. But what we did with Kamala, we decided to retain that money in her super. So she did not start a pension. She left her money into an accumulation account, into a super account. Furthermore, we invested $13,000 each into funeral bond. Now, all this is leading to is a Centrelink. The reason for that is funeral bonds do not count, or Centrelink's given exemption on funeral bonds, and up to 13,000 at that time, it's 15,000 now, does not count as an asset. So we were able to put another 13,000 in each, both of their names. And this is for the future planning purposes, where when Kamala becomes age pension age, we would do another trigger point in the strategy where we would change what we'll call a lifetime annuity will commence when Kamala turns 67 in 3 years' time. So there's multiple steps happening here. The reason for that is, as you would note, there's a bit of a 4 years difference between the clients' ages. Having Kamala's money sitting into super, into accumulation account, does not count as an asset from a Centrelink point of view. So that was the main trigger why we held majority of money, the $440,000 that we left into Kamala Super. We left that for that reason, because it does not count as an asset for her. Had we put that money into a pension, had we started a pension for her, that would count as an asset, and they would not be entitled to any support from the government. Now, as a result of that, because we left the money in there for 3 years, so there were 3 to 4 years age difference between them, that for additional 4 years, Donald would be able to receive Centrelink support, and he would be able to get full age pension, because we were able to reduce their threshold. Now, let's just talk about the Centrelink. With Centrelink, when you apply for age pension, I'm not sure, some of you may have supported your parents in that or a family member. With Centrelink, anytime you apply for a support or a government assistance, you have to meet certain criteria. Because in this one, we are focusing on age pension has its first, you've got to meet the age limit, which used to be 65, but now it's moved to 67. So government's continuously pushing the goalpost a little bit because we are living longer and people are working longer. So age pension age is now moved to 67. Now, as a result of that, you got to meet the age test first. So the Donald does qualify because he is 67. Kamala does not because she's 63. So she does not meet that criteria. The next one is means testing. What I mean by that is the government looks at the amount of assets the client have and the amount of income that clients get. So they run two tests, an asset test and an income test. And depending on the test that gives you the lower entitlement is what the client's entitled to get. So for example, a client may get a full entitlement under asset test, but because of the spouse working, may get only part pension entitlement under income test. So in that situation, government would only give them the lower amount, not the full amount. Now, in our situation for Donald and Kamala, they were failing under asset test because a couple limit is about $1 million. It's about $1 million, $45,000 that a client's entitled to have. Anything over that, they're not entitled to, and then the pension cuts off. So the reason for all these changes was to ensure that the client can get some support, and then that would also help. That means they're not drawing enough money from the super. The super can last them longer, and it was able to help them increase their pension payment sort of thing. So this is at a high level. So let's keep moving on the slides. Guys, if you've got any questions, please feel free to ask. Talking about super, so like I was saying before, we cannot choose or we cannot tell our super fund how to or where to invest the money, but what we can tell our super fund how much risk we are willing to take. And we also should be looking at how much fees are we paying in our super. So as a part of the clients, we did a super review where we found out that the clients were invested in a higher risk portfolio where they were taking a lot of risk, which is fine when you're younger, but as you get older, it's recommended generally to bring it down a little bit, because if we were to have another GFC or a COVID event, it takes a lot longer for retirees to recover that money, because not only have their balance drop, but they're also drawing money to meet the living expenses from. So we were able to do that review for the super on the client situation, but not only did we fix the asset allocation, we also looked at their fees that they were paying on their account. So in this situation, the clients were paying a 1% fee. We were able to bring it down to a 0.35%. So on $1 million portfolio, that was a significant amount of saving just on fee part alone for the client. So it's very important to ensure that we, what we are paying within our super funds and how we are invested. Second part of the strategy, when we are looking at the part of the contribution that we were discussing before, where Donald put a contribution of $60,000, where we were able to make non-concessional contribution into Kamala's name and not starting a pension with her super account. We just retained it within the super. They were, as you can see from the chart, they went from $0 entitlement for the first few years to almost full pension payment. So that retaining money into super, starting a funeral bond, helped client not only from a Donald's point of view, he got a big chunk of money on the tax return. I don't think we have put that table here, but there was a big calculation because it was $60,000 deduction. So his taxable income went from $100,000 to $40,000, which meant that he was a significant amount of saving in tax. Along with that, if you look at just a combined total Centrelink benefit, had they not done anything to what we were able to achieve for the client, there was almost $61,000 additional pension payment that they were able to receive with the different strategies that we implemented. And if I move on to the next slide, So this is where we've sort of analysed the current and proposed scenario just to understand what impact had the strategy really made for the client situation. So the blue bar is the asset level. So how much is the asset for their life expectancy? How much asset would they have to support themselves? Because client, not only did they want to support themselves, they also wanted to pay, give out some inheritance to their kids. So they wanted to pass on some money too. As a result of all the strategy, if they had not done anything, they would have ended up with $322,000 in their net assets. But as a result of the strategy, they were able to, the net projected level was sitting at $587,000. So there was that additional over $260,000 that client was able to achieve just by moving the money around a little bit and delaying the pension payment, delaying the income that they were receiving from that they would have received from the super. So by making small changes, we were able to have a big impact on client's situation. Another thing that I sort of pointed out, that when Kamala is pension age, so in 4 years' time when she's 67, her super money would count as an asset. So the recommended part on this strategy is for her to start a lifetime pension, which allows her further reduction in her asset test. And it also means that she gets another income stream that pays her for the rest of her life. The continuation of that helps the client to get a better outcome on their retirement. And that is part of my thing, Gianni. Over to you. I'm not sure if you have any question. Happy to take any question, by the way.
Thank you very much, Ricky. Really appreciate it. Thank you for those insights. Yes, as Ricky mentioned, now is a great time for people to ask any questions that they have on this particular scenario or anything related to this scenario. In addition, if you are looking to get specific financial advice on your personal circumstances, Ricky's contact details are there. If you scan the QR code, it will take you to a booking page that will allow you to book in time for an initial complimentary consult with Ricky as well. So if you do have any questions, you don't want to air them in this forum, please don't hesitate to reach out to Ricky using his email, phone, or through booking a consultation using the QR code attached there. Otherwise, I'll leave it for another moment for any questions to come through on the Q&A forum or on the chat. But apart from that, I want to thank Ricky, first of all, for providing his time and expertise to us in this forum as well. And thank you all very much for attending. Please don't hesitate to get in touch if you do have any questions. I'm more than happy to answer them. But thank you for attending and have a great day.